Hello everyone, this is Rob McDougall from Zhang Financial here with your weekly economic update. Today is Tuesday, September 2nd, 2025. So last week, in terms of economic activity that was released, everything really hit on Friday that was important. We'll just briefly mention the fact we had building permits, new home sales on Monday last week. No impact between those two. One was up, one was down slightly from expectations, so no real data there. On Tuesday, we had durable goods, which is expected to be a big drawdown in terms of the headline number. It was expected to be down 4%. Month of July it was actually down 2.8, so that was slightly better than expected. Initial jobless claims pretty much in line, 230 versus 229 expectation. Pending home sales down a little worse than expected. So no real news during the first 4 days of the week. On Friday was the big one. Everyone was anticipating the inflation numbers, personal income, personal spending, and the Michigan Consumer Sentiment Index. And at the end of the day, I have not seen anything more in line than what we had with these metrics last week, Friday. So core PCE, month over month, year over year, personal income, personal spending, PCE, the price index, headline number, month over month, year over year for the month of July. For all of those metrics, absolutely laser pinpoint, exactly as consensus expected. So I haven't seen that before. It's great. We did the Michigan Consumer Sentiment Index. That was expected to be 58.6, came in at 58.2. It's been weak for some time, so no real content there. So in terms of economic news from last week, nothing that I would have thought moved the needle. Nonetheless, the Atlanta Federal Reserve took up their expectation for third quarter GDP growth. This is pretty significant, very significant. They were at 2.2% the week before. They moved that up to 3.5%. That would be pretty remarkable, particularly second quarter. We already had a revision, first revision to the GDP report had come in at 3%. And remember, the first quarter was extremely, well, it was negative due to imports regarding the tariff situation. So abnormally high was the second quarter GDP number, but the first read was 3.0, then came in at 3.2. The fact that the Federal Reserve of Atlanta thinks we're going to grow 3.5% in the third quarter simply means the economy is doing much better than expectations, particularly given weakness that we've seen in the labor markets. Inflation expectations, no real change there. Still, the break-even indicates expectations of 2.41% average inflation over the next 10 years. In terms of the Fed funds future market, we do have a Fed meeting on the 16th and 17th. 17th, they'll be announcing a cut or not. 90% probability we get one cut. And then by the end of the year, we've got 85% probability that we'll get at least two cuts and 35% probability that we get three cuts. All of those probabilities slightly increased last week, but pretty close to what they were the week before. Last thing I'll mention here, we have a client down in Houston who was simply concerned, pointing out valuations are high in the S&P 500. There's no question they are. They have been for some time. One chart that I haven't put in here that we do use with clients is simply the predictability that when the S&P 500 is high over the next 12 months, does that tell you anything about returns? And it really doesn't. The R squared is incredibly low, like 0.1. And when it is high, S&P 500 multiple is high over the next 3 years, it does have some predictive quality to it, but it's much lower than you would think. And the R squared is about 0.4 for that. So simply looking at valuations right now, they're high, no question about it. S&P 500 trading at a 22.2 times forward earnings as of Friday. But if you take out the top 10, a little more reasonable, it's 20.6 times. Now the trailing 30-year average is 16.8. We haven't seen that in quite a while. So I throw it out there. It's sort of trivial pursuit. Doesn't really matter. Valuation's high, but certainly elevated due to the Mag 7. So in terms of the Mag 7, I'll just finish here for last week. Year to date, showing the S&P up 10%. It's closer to 11, 10.7, let's call it. But out of that, the Mag 7, which may surprise people, is in line for the year. It's up 11%, so slightly better than the other 493 names in the S&P 500. So let's take a look at what happened in terms of returns last week. It gave you the economic activity, and very much like the economic activity, hardly anything changed last week. S&P 500 down 8 basis points. The equal weighted S&P was down 50 basis points, but there's really nothing that sticks out last week. The market really meandered, no real direction. International markets, which have been and definitely outperformed the U.S. market year to date, but the developed markets ex-U.S., poor week, minus 1.11%, and emerging markets down 64 basis points, and China down about the same, down 57 basis points. Fixed income last week, U.S. actually up. Fixed income having a very nice year. The 2-year, 10-year yields both down. The 2-year down 8 basis points, 10-year down 3. So the Bloomberg U.S. Aggregate Bond Index was up 16 basis points and up nearly 5% on a year-to-date basis. So let's take a look at the calendar for this week in terms of economic activity. We'll start off today, actually. ISM manufacturing, I haven't seen it yet, but the PMI expected to have improved for the month of July. That was at 48. 50 is the demarcation line between contraction and expansion. Expectations is a slight improvement up to 49. Now, I mentioned the fact that the jobs market has been particularly weak. The data points we're seeing, we'll talk about Friday, which is going to be a huge day. On Wednesday, tomorrow, we'll get the JOLTS job opening. That's expected for the month of July to be a little bit weaker than we saw in the month of June. So on Thursday, we'll get another labor data point. It's the ADP employment change. That was surprisingly strong last month of July. And then you may recall the next day we had the BLS number, or 2 days after, I think it was. But the BLS number was very weak, really rocked investors at that point. But the ADP employment for the month of July came in at a positive 104. That was upside. The expectation for the reading on Thursday will be a positive 68,000. In terms of initial jobless claims, expected to be in line with what we had last week, about 230,000. And also on Thursday, ISM services, which has been weak. Just a year and a half ago, we were in the 55 range. The month of July, we were at 50.1, so very close to that break-even point. The expectation is, the consensus expectation is it will come in at 51 for the month of August. Now, Friday is the big day. Non-farm payrolls last month of July, surprisingly weak. It came in at 73,000, and the revisions were horrible. Just no way to sugarcoat it. The expectation for August is non-farm payrolls will come in at a positive 75. We'll see how that goes. Unemployment rate is expected to tick up to 4.3%. Average hourly earnings, however, that is expected to be in line with what we saw in July. July was a positive 0.3%. Same expectation for the month of August, 0.3%. So that's it for a recap of last week's economic and market activity and a preview of this week's economic data yet to be released. Thank you very much for attending. We'll look forward to seeing you next week. Thank you.